Good evening, everyone. This is Abhishek Chinchalkar. I'm your host today, and I'll take you through this presentation, through this webinar. The topic of today's webinar, as you all are aware of, is introducing the RSI indicator and then discussing some basic RSI strategies. I would like to remind you that this is a part of two series webinar on RSI. So we'll hold the second webinar on RSI sometime next week, and that will be more on advanced trading strategies using RSI. But today we'll just stick to the basics of RSI. We'll talk about what the RSI is, how it is calculated, and then speak a few basic strategies that you could deploy using RSI. So as I said, my name is Abhishek Chinchalkar. I'm the head of education at FYERS. I head the education initiative at FYERS, and I actively contribute to the FYERS School of Stocks, which is our online stock market education initiative. So I write various chapters on various modules on School of Stocks relating to various aspects of the financial markets. From an educational credential perspective, I'm an active CMT charter holder, and I'm also an executive MBA from SP Jain School of Global Management. I have a rich 10 plus years of work experience, predominantly on the research side across asset classes, that is equities, commodities, and currencies. My key expertise lies in technical analysis and intermarket analysis. So that's brief about me. As I said in the previous deck, we have a portal called School of Stocks, which is our online stock market education initiative. So this is the screenshot of the homepage of School of Stocks. I've shared the URL of School of Stocks at the top, as you can see. So in case you want to learn ins and outs of financial markets, be it relating to what stock market says, be it relating to technical or fundamental analysis, derivatives, options, futures, intermarket analysis, risk management, etc. We have covered these modules very much in detail in School of Stocks. So if you're interested in learning about this, you can visit School of Stocks. It's a free website, so you can read modules and chapters on our platform without any login or any credentials. So it's an open platform. So this is something that you could refer to later in case you're interested in learning about the stock markets in general and about various aspects of trading and investing. So again, the agenda today is to talk about the RSI, as you all are aware of. So let me get started by introducing the RSI indicator. The RSI indicator stands for the Relative Strength Index. It's been in existence for well over 4 decades now. It was introduced in 1978 by Welleswelder Jr., who is considered to be the father of modern technical analysis. He has introduced some great technical indicators that are widely used even 40 years after he had invented them. He had introduced them. Speaking of RSI, RSI is one of the most popular indicators that is used across the world. So every trading platform has the RSI indicator, and by far, along with moving averages, RSI is one of the most used and most researched indicators, technical indicators out there. And these are some of the very well-known, the revolutionary works that Welleswelder did in the late 1970s. So he developed some excellent indicators such as the Relative Strength Index, the Average True Range, the Directional Movement Index, the Average Directional Index, and Parabolic SAR. Each of these indicators are there in our FYERS web and FYERS app platform. So in case you're interested in using them in making your trading decisions, feel free to do so. It's there in our FYERS app, FYERS web platform. So let me start by talking about the basics of the RSI indicator. So the first thing that you need to keep in mind is that RSI is an indicator that measures the momentum of the price of a security. So it calculates the momentum or the velocity of the trend of a security. So that is the foremost objective of the foremost purpose of RSI. Now, if you attended my previous webinar, which was on MACD, back then I said that MACD is an unbounded indicator. It can go to positive infinity and it can drop to negative infinity. On the other hand, one thing that you need to keep in mind about the RSI is that unlike MACD, RSI is a bounded indicator. So it fluctuates within a fixed band of 0 and 100. Neither can it go below 0, nor can it rise above 100. Now, because of this feature of RSI, one of the key advantages of using RSI is that you can compare the RSI readings across securities. So irrespective of whether you're looking at a one-digit security, such as say, Vodafone, or if you're looking at a 5-digit security like say MRF, it doesn't matter because RSI is pretty much standardized. It fluctuates between 0 and 100 across securities. So that is one of the key advantages of RSI, that you can compare it across securities. As you might be aware of, RSI is a derivative of price. It is calculated using the closing price of a security. So it is derived from the price of a security. Now, the objective of using RSI is twofold. Number one, RSI lets you identify what the trend of the security is. So by looking at the historical readings of the RSI, by looking at the swings of the RSI, you can get to know in general what the trend of the security is. And number two, RSI also helps you in identifying what the momentum or the velocity of the trend of the security is. So the purpose of using RSI is twofold. Number one, to identify the trend of the security, and number two, to identify the momentum of the trend of the security. Now, as I said earlier, RSI is a very widely used indicator. It also happens to be one of the most versatile indicators out there. So RSI has plenty of usages, which we will be discussing about later in this webinar, as well as in the next webinar next week. So this is how the RSI indicator looks like. Price, as you can see, is plotted on the top, while on the bottom panel, if you see, is the RSI indicator. So as you can see, this purple line is nothing but the RSI line. Also, there are two horizontal dashed lines that you can see. One is pegged at 70 and other is pegged at 30. Now, what these 70 and 30 values are, I'll talk about later in this webinar. So as you can see in this RSI panel, what an RSI panel consists of is the RSI line and two horizontal lines that are typically marked at 70 and 30. So this is how the RSI indicator looks like on a charting platform, on our FYERS web platform. So that was a brief about the RSI indicator. Let me now go into the calculation, the construction part of the RSI indicator. Now, there is a little bit of mathematics involved in this part. Now, while it's not an absolute must that you need to be aware of how the RSI is calculated, but if you know how the RSI is calculated, if you know the mathematics behind the RSI, then you stand to benefit in terms of, number one, you can make modifications to the settings of the RSI as and when the market conditions are changing. So if you know how RSI is calculated, it'll be relatively easier for you to make tweaks in the RSI settings. And number two, if you want to develop a system based on RSI as well as other parameters in, say, Microsoft Excel, or if you want to code it using any programming language, then you need to know how the RSI is calculated. So it is for this reason that I'll briefly talk about how the RSI is calculated over the next few slides. Now, there are three components that go into the calculation of the RSI indicator. One is average gains and average losses. The other is the relative strength or the RS value. And the third is the RSI or the relative strength index value. So the third is, the ultimate purpose for which you are calculating the RSI indicator. So these are the three parameters that go into the calculation of the RSI indicator. Now, as you might imagine, there are three steps that are involved in the calculation of RSI. In the first step, once you have the closing prices for the past n periods, based out of that, you calculate the average gains and average losses for the past n periods. Once you have the average gains and average losses, from that you can calculate what is the RS value. And finally, once you have the RS value, from that you could calculate what is the final RSI value of the security. So that's how you perform RSI calculation. It's a three-step calculation, wherein in step one, you calculate average gains and losses. In step two, you calculate the RSI value, you calculate the RS value, and in step three, you calculate the RSI value. So let me briefly talk about each of the three steps before we proceed to the practical application of RSI. So in step one, as I said, now the default reading for the RSI indicator is 14. So if you're on the daily time frame, you would be calculating the 14-day RSI. So for the purpose of this demonstration, let us assume that we are trying to calculate the 14-day RSI and try to understand how the 14-day RSI is calculated. Now, as I said, in the first step, you need to calculate the average gains and average losses. Now, the first average gain and the first average loss you calculate, that would be based on simple average formula. So the first average gain that you calculate will be nothing but the total gains over the past n periods, which in our case is 14, divided by 14. So the first average gain that you calculate will be the total gains over the past 14 days, and that you will divide by 14. So what you get is the simple average, the first average gain that you have calculated. In a similar fashion, the first average loss that you calculate will be the total of losses over the past 14 days divided by 14. So that's the first average loss that you have computed. Once you compute the first average gain and first average loss, every subsequent average gain and average loss that you will compute will be based not on simple average, but will be based on the Wilder averaging system. So every subsequent average gain that you compute would be computed this way. So the previous average gain, that is the average gain that you calculated in the previous on the previous day, that average gain would be multiplied by n-1, which in our case is 14 minus 1, that is 13. So the previous average gain would be multiplied by 13, and to that value, the current day gain would be added. And then this entire expression would be divided by 40. So each and every subsequent average gain that you calculate would be calculated this way. The formula is previous average gain times n-1 plus current gain upon n. Now, don't get too worried about this. I'll later show you how this can be simplified in Microsoft Excel. So just hang on with me for some time. Similarly, every subsequent average loss that would be calculated as previous average loss. So whatever that figure was, to that figure, you'll multiply by n-1, which in our case is 13. And to that expression, you'll add the current day loss and then divide this entire expression by n. So let me go through step one again. The first average gain and the first average loss that you will calculate will be based on simple average. Every subsequent average gain and average loss that you will calculate will be based on the Wilder averaging system. Why Wallace-Wilder devised the RSI this way is to smooth out the data and to ensure that whenever RSI is calculated, let us say whenever you calculate 14-day RSI, even the older data stays in the calculation and is not totally erased from the calculation. It is for this reason that in order to smooth out the data, the RSI is calculated this way rather than using the simple average for each and every average gain average loss calculation. So that's step one. I'll show this later in Microsoft Excel to simplify the calculation. Steps 2 and 3 are very straightforward. Once you have average gains and average losses, you can calculate the RS value, which is nothing but the ratio of average gains to average loss. So it is average gains divided by average losses. Finally, you calculate the RSI. RSI is nothing but 100 minus 100 upon 1 plus RS. So this is the formula for RSI. Now, as you can see, 100 is used on the left of the expression as well as on the right. It is because of the way the RSI formula is structured. It is because of this that the RSI fluctuates within a fixed band of 0 and 100. So it is this formula that you see over here, 100 minus 100 upon 1 plus RS, that causes the RSI to be confined to the 0 and 100 range. This formula ensures that the RSI never goes below 0, nor does it go above 100. So this is how, these are the 3 steps that are involved in the calculation of RSI. Again, it is very beneficial that you know how RSI is calculated, because whenever you want to develop a system on Microsoft Excel, or whenever you want to code RSI to generate automated signals, you must know how the RSI formula is calculated. So this is the Excel snapshot that I have performed. So rather than showing this, let me go to Microsoft Excel. Can you see my Microsoft Excel spreadsheet over here? Is it visible?
Yes, Abhishek, it's visible.
Okay, great. So let me proceed. So for the purpose of our calculation, I've calculated the 14-day RSI, and the underlying that I've chosen is Nifty. As I said, RSI is based on the closing price of the security. So closing price is what matters to the calculation. Open, high, and low are not relevant. Now I've taken the data from 31st December 2020. So from 31st December 2020 till date, I've calculated the RSI. So the closing price is something that you can fetch online from, say, the NSE website. Now, once you have the closing price, the next step that you need to do is to calculate the change. Change is nothing but the current day price. As you can see over here, change is nothing but the current day price minus the previous day price. Now, change could either be positive or it could be negative. If the security has risen in price, then the change will be positive. And if the security has fallen in price, the change will be negative. Now, once you calculate the change, you need to create 2 additional columns, one for gain and the other for loss. You need to segregate positive change and negative change for the simple reason that going forward, you need to compute average gains and average losses. So you separate change into gains. So there is one column for gains and the other column for loss. So whenever change is positive, that positive number comes into the column of gain, and in the corresponding column of loss, you have 0. And whenever the change is negative, as you can see over here, that number is feeded into the loss column, and the corresponding gain column, you feed in 0. Now, when writing losses, you can ignore the negative sign because we need to do it later. So just consider the positive losses and ignore the negative sign. Just ignore the minus sign. So as you can see, whenever the change is positive, it's in the gains column, and the corresponding losses column is 0. And whenever the change is negative, it's feeded into the losses column, and the corresponding gains is inputted as 0. Now, once you have the 14 period gains and the 14 period losses, you're all set to go ahead and compute the average gains and average loss. Now, as I said previously, the first average gain that you calculate will be based on simple average. So you can use the Excel formula, which is average of, the average gain will be nothing but average of cells E3 to E16. And similarly, for average loss, it will be simple average. The first average loss will be based on simple average. So it will be average of F3 to F16. RS calculation is very straightforward. It's nothing but your average gains upon average losses. And finally, you have RSI, which is nothing but 100 minus 100 upon 1 plus RS. So that's very standard. RS and RSI calculation is very simple. So we have calculated the average gain and the average loss for the first period. That is, we have calculated the first average gain and first average loss. Every subsequent average gain that you calculate will be based on the formula that I discussed earlier. It is nothing but the previous average gain, which is nothing but 103.94 that you see over here. That will be multiplied by 13, which is n minus 1. And recollect that we are calculating 14-day RSI. So n minus 1 will be 14 minus 1, which is 13. So it will be multiplied by 13. And then the current day gain will be added to it, which is 0 in our case. As you can see, the current day gain is 0. And this entire expression would be divided by 14. So what we have is a smoothed average for each and every subsequent period. So every subsequent average gain that you see would be calculated this way. Similarly, every subsequent average loss would also be calculated this way. So average loss would be the previous average loss, which is 26.89 in our case, times n minus 1, which is 13, plus the current day loss, which happens to be 54.35. And then this entire expression is divided by 14. And the calculation of RS and RSI remain pretty much the same. So that's how the RSI is calculated. Now, if you go to the bottom, you'll see that the current RSI reading is 83.86. Let's just cross verify on FYERS web. So you can see the RSI value comes over here. So if you see the current day RSI is 83.8641. So that's pretty much bang on. If you look at the previous RSI, it's 81.20. So let me just scroll over to the previous day. So if you look at the RSI, it's 81.1982, which is 81.20. So we get the exact figures in the trading terminal as well. So this is how the RSI is calculated. So we'll be sharing the recording of this presentation in a day or two. Once we do that, I'll also try to share the Excel sheet so that you can work around the RSI calculation in case you feel like. So now let me go back to the presentation. So now that you know how the RSI is calculated, let me just summarize the key takeaways from the calculation of the RSI. The first thing that you need to keep in mind is that RSI is based on the closing price of the security. The open, the high, and the low are irrelevant, and only the closing price of the security is taken into consideration. The default reading for RSI is 14 period. So if you're looking at the daily chart, the default reading is 14-day RSI. If you're looking at the monthly chart, the default reading is 14-month RSI, and so on. RSI fluctuates within a fixed band of 0 and 100. Neither can RSI drop below 0, nor can it rise above 100. Now let's come to the readings of RSI. Now, as I said, RSI fluctuates within a fixed band of 0 and 100, and 50 is the midpoint of the reading. 50 is the reading that divides the bullish zone from the bearish zone. You can think of it as a median or the midpoint. Again, let's go back to the formula. So RS, let's go back to step 2, which is calculation of RS. RS is nothing but average gains upon average losses. This expression could either be greater than 1, it could be less than 1, or it could be equal to 1. Whenever RS is greater than 1, now that would happen when average gains is a bigger number than average losses. So whenever average gains is a bigger number than average losses, RS would be greater than 1. In that case, RSI will be above 50. Similarly, when average gains is smaller than average losses, RS will be less than 1, in which case RSI will be below 50. And finally, when average gains and average losses are exactly equal, RS value will be equal to 1, in which case RSI will be at exactly 50. So what I intend to say from this is that whenever the RSI value is above 50, it means the average gains over the past n periods exceeds the average losses, which is bullish because average gains are exceeding average losses. Similarly, whenever the RSI is below 50, what it tells you is that the average losses are greater than the average gain. So it tells you that the momentum is bearish because average losses are more. Finally, when the average gains and when the RSI value is exactly 50, it tells you that the average gains and average losses are the same, and there is a sort of equilibrium in the market. So as you can see from the final 3 points, whenever the RSI is below 50, it implies that average loss exceeds average gains over the past 10 periods. Whenever the RSI is above 50, it implies that average gain exceeds average loss over the past 10 periods. And finally, whenever the RSI value is exactly 50, it tells you that average gains and average losses over the past n periods are equal and market is in a state of equilibrium. Whenever RSI is above 50, it tells you that the bulls are in control. Whenever the RSI is below 50, it tells you that the bears are in control. And whenever RSI is at 50, it tells you that there is a sort of equilibrium in which bulls and bears are more or less equal, and neither one party is dominating the other. So that was all about the calculation part of RSI. Now let's proceed let's proceed to the practical application of RSI. Again, to keep things simple, in this webinar, we'll only talk about the basic elementary stuffs relating to RSI. In the next webinar that we'll conduct next week, we'll talk more about advanced trading strategies and practical applications of RSI. So the first interpretation that you need to make is that, see, at any point in time, the RSI could be above 50 and it could be rising. So if the RSI is above 50 and if the RSI is rising, what does it tell you? Remember again, I said earlier that whenever RSI is above 50, the bulls are in control. So the momentum is bullish. So whenever RSI is above 50, it tells you that the momentum is bullish. On top of that, if the RSI line is rising, it tells you that the bullish momentum is strengthening. So whenever the RSI is above 50 and rising, it tells you that the bullish momentum is strengthening. Now, this is a bullish factor. On the other hand, if the RSI is above 50, but it is falling, so if the RSI line is above 50 but falling, it tells you that the momentum is still bullish, but the strength of the bullish momentum is weakening. The velocity is weakening. So RSI above 50 but falling indicates that the bullish momentum is weakening. Now let's switch to the other side of 50. Whenever RSI is below 50 and falling, it tells you that not only is the momentum bearish, but that bearish momentum is strengthening. So whenever RSI is below 50 and falling, it tells you that the bearish momentum is strengthening and that the bears are gaining more and more control of the prices. Similarly, whenever the RSI is below 50 but rising, it tells you that the momentum is still bearish, but that bearish momentum is weakening. The bears are sort of losing power. Although they are still in control, they're losing power. So this is the first basic interpretation of RSI. Now, this is the daily chart of Nifty for the past 1 year, almost 1 year. As you can see, I have drawn in the RSI indicator, I have drawn a horizontal white line precisely at 50. So that white line is the line that separates bullishness from bearishness. Whenever RSI is above 50, it tells you that the momentum is bullish, and whenever RSI is below 50, it tells you that the momentum is bearish. Now look at this first upward sloping white arrow that we have. Here what is happening is that the RSI line is above 50 and the RSI line is also rising. So what that tells you is that the bulls are in control and they are gaining strength. But then look at this second downward sloping white arrow. The RSI is above 50, so it tells you that the bulls are in control. However, the RSI line is falling. So what it tells you is that the bulls are sort of losing their strength. If you look at the price action during this period, you'll notice that after this rally, price had become sideways. So there was a sort of equilibrium between bulls and bears. Although the consolidation is taking place at top, indicating that the bulls are still in control, but still what happened in this region was that the bulls were sort of losing strength. And that is indicated by the RSI. Then the RSI declined, tested the equilibrium line, which is the 50 line. And from then there was a resumption of the bullish momentum again. So if you look at the third upward sloping white arrow, you will see that not only is the RSI above 50, but it is rising. So what that tells you is that not only are bulls in control, but they are gaining strength. Now, again, I've reiterated the basic principle of RSI. So whenever RSI is above 50 and rising, the trend is bullish and the bullish momentum is strengthening. When the RSI is above 50 but falling, the trend is still bullish, but the bullish momentum is weakening. On the other end of the spectrum, whenever RSI is below 50 and falling, the trend is bearish and the bearish momentum is strengthening. And finally, whenever the RSI is below 50 but rising, the trend is bearish, but the bearish momentum is sort of weakening. So just by looking at the RSI and comparing it with the price, you get a clue of whether the momentum is bullish or bearish, and whether the prevailing momentum is strengthening or weakening. So that is the foremost basic objective of using the RSI indicator. Number one, to find the trend, and number two, to find the momentum of the trend. Now let's talk about the second basic RSI interpretation. Now you might have, if you have ever heard of used RSI indicator before, you'll frequently have heard of this 70 and 30 zones. Now what are these? These are typically called overbought and oversold zones. So whenever RSI rises above 70, it tells you that the price of the security is sort of becoming overbought, the trend of the security is becoming overheated. Similarly, whenever the RSI is below 30, it tells you that the selling has accelerated too much, and we may be nearing a sort of a region wherein the sellers would eventually fade out. So very loosely speaking, 70 is considered as overbought and 30 is considered as oversold. However, the biggest mistakes that especially those who are new to trading, when they start using RSI, the biggest mistake that they make is blindly trading whenever RSI touches 70 or touches 30. Sometimes traders tend to blindly sell whenever the RSI is risen to 70, and blindly buy whenever the RSI has fallen to 30. Now, that's a very dangerous thing to do. One thing that you need to keep in mind is that whenever RSI rises to 70, it doesn't mean a sell. Similarly, whenever RSI falls to 30, it doesn't mean a buy. You need to wait for confirmation from the price. Again, I'll keep reiterating in this webinar again and again, price confirmation is absolutely necessary before you decide to take a trade on the basis of RSI, or for that matter, on the basis of any other technical indicator. Confirmation from price is absolute must. Now, again, this is a sort of warning chart that I've put in over here. Now, this is the daily price chart of Bank Nifty. Now, if you look at this point over here, the RSI touched 70 and precisely Bank Nifty topped over there, and then there was a healthy correction. That correction kind of ended when the RSI touched the oversold zone, as you can see over here. So in these two cases, the overbought zone acted as a good selling area and the oversold zone acted as a good buying area. But if you look from the time Bank Nifty bottomed out till the time these overbought oversold levels were reached, the Bank Nifty was in an uptrend. Now later on, see what happened. From this oversold region, the RSI started rising and ventured into the overbought region. Now look at what Bank Nifty did in between these two white lines. The RSI was frequently getting overbought, but the Bank Nifty kept rising. Never did it show signs of fatigue and show signs of reversal. As you can clearly see, Bank Nifty is continuing to make a series of higher highs and higher lows, which is a classic definition of a security in uptrend. So imagine trying to sell Bank Nifty blindly whenever the RSI had ventured into the overbought territory. Towards the left horizontal line, if you see at that point in time, Bank Nifty was trading at 26,000. And towards the right vertical line, if you see, Bank Nifty was trading at almost 36,000. So it was a 10,000 point rally. during which the RSI frequently ventured into the overbought zone. So trying to sell Bank Nifty just because the RSI is venturing into overbought zone would have turned into a disastrous trade. So one thing that you need to always keep in mind is that just because RSI has gone into overbought doesn't mean that you should blindly be selling the security. As I said previously, you need confirmation from the price itself. And in this particular case, the price never gave that confirmation. If you look at the candles, they are steadily heading higher and higher. So no sell signal was generated in the price. So this is one instance that you would like to totally avoid. Without confirmation from the price, don't sell just because the RSI has risen to overbought, or don't buy just because the RSI has fallen to oversold. Then finally, there is one instance over here wherein the RSI hit the oversold region, and that is where the Bank Nifty bottomed out and started rising. So if you look at this buy that was signaled over here, which coincides with this point, you could have used some Japanese candlestick patterns or some other confirmation and then traded once price had given a signal. So from this decline, price started rising, consolidated for 2 days, and then went higher again. So you can consider this as a sort of minor breakout and then consider buying over here while keeping a stop loss below this swing low. So that is how you can trade using RSI. But as I said, that confirmation from price is necessary. In case of this portion over here, there was no sell confirmation from the price despite the RSI rising to overbought. So in this particular region, there was no sell signal that the price by itself gave. Now let's talk about the third basic interpretation of RSI. Once you start using RSI, you will notice that when a market is trending, RSI tends to behave in a particular fashion than when a market is not trending. So in an uptrend, when the price of a security is in an uptrend, you will often see that the RSI is quite easily touching the overbought zone, the 70 zone, but struggling to touch the oversold zone, as we saw in case of this Bank Nifty chart over here. The Bank Nifty, right from the time it bottomed out, it was in a very strong trend. And because it was trending higher, notice that the RSI of Bank Nifty was easily touching overbought, but it was very rarely touching the oversold zone. So what I mean to say by this is that the RSI tends to stick to the prevailing trend. So if the prevailing trend is up, the RSI tends to frequently rise to overbought, but very rarely does it fall to oversold zone. Similarly, whenever the price of a security is in a downtrend, the RSI tends to very frequently fall to oversold zone while it struggles all the way up to come to the overbought zones. So in a trending market, the RSI tends to stick to the trend. Well, what about the ranging market? What about the time when the market is in a consolidation zone? So when the market is consolidating, when there is no clear trend that is evident, you will notice that the overbought and oversold zones are, evenly touched. So whenever the RSI rises to overbought, you'll see the price topping out and declining. And whenever the RSI falls to oversold zone, you'll see the price bottoming out and starting to rise. So in a ranging market, in a market that is in a sideways trend or consolidating, you will see that the overbought and oversold zones are sort of evenly touched. So this is a topic that we'll discuss in more detail in the second webinar, because great signals can be generated, great trading signals, buy-sell signals can be generated using this. But in this webinar, we'll just stick to the basics. Now, this is the very long-term chart of HDFC Limited. This is the monthly chart with data ranging back from 1998 till present. So it's a sort of 20-year data. Now, the objective of including this chart is to show that RSI can be used in long-term on the longer time frame as well. You can use RSI on the monthly time frames or even on the quarterly time frames if you have that much of price data. So one important thing that you need to keep in mind is that RSI is universally applicable across all time frames, be it a time frame as small as 1 minute to a time frame that is as large as 1 month or 1 quarter. So RSI is a very excellent and a very versatile indicator that can be used across time frames. Now, this is the monthly chart of HDFC Limited. As you can see, since the inception of this chart, HDFC Limited has been in a very powerful uptrend. And notice how the RSI is behaving. Now, the horizontal lines that you are seeing are the traditional overbought, oversold lines, 70 being overbought and 30 being oversold. If you notice in the entire 20-22 years history of HDFC Limited, the RSI has never ever touched 30. In fact, it has even struggled to fall below 40. Now, the only instances wherein it fell to as low as 40 was during the dot-com bubble of 2000, during the global financial crisis of 2008-9, and during the 2020 COVID-19 crisis. Only during these crisis times did the RSI indicator of HDFC Limited drop to even 40. The oversold region of 30 was never ever tested. On the other hand, if you look at the other extreme of RSI, you will see that it is very easily climbing above the traditional 70 overbought zone. It's going even above 80. So that tells you that in this entire 22-year journey of HDFC Bank, the trend overall has been very powerful. And that is causing the RSI to fluctuate not within the traditional band of 30 and 70, but within a band of 40 and 80 to be precise. In fact, if you look, it's not even 40. In a majority of the cases, whenever the RSI has fallen, it has taken support of 50. So the equilibrium line is acting as a support. Now that is how the the strength of this overall uptrend of HDFC Limited has been. Later, I'll show you can change the overbought oversold settings to adjust to the behavior of RSI. So the default reading is 70 and 30 that you can change. And in the case of HDFC Limited, I've changed it to 80 and 35 respectively. So I've changed the overbought region to 80 and I've changed the oversold region to 35. So as you can see, whenever RSI has fallen towards these oversold regions, the upcoming rally has been very powerful. And whenever the RSI has risen above 80, that has not marked trouble. It's just that there has been a sort of consolidation to minor correction before the rally began again. Again, the purpose of this chart is to show that RSI can be used on longer time frame charts and that you can change the overbought and oversold readings of the RSI as per the behavior of the RSI for a particular security. So feel free to change the overbought and oversold settings in the charts that you are looking at. Now, the fourth basic interpretation that I would like to talk about is something that I've already iterated. As I said, in a trending market, RSI tends to stick to the trend. So if you're in a clearly defined uptrend, whenever the RSI is falling towards the oversold zone, you can use that opportunity to go long, provided there is a buy confirmation from the price itself. And whenever within an uptrend, whenever the RSI touches the overbought region, you can use it to trim existing longs if there is a confirmation from price. Again, the key is that there has to be confirmation from price before you decide to either enter a trade or before you decide to exit your trade. That price confirmation is absolute must. Similarly, in a downtrend, whenever the RSI approaches the overbought territory, you can use that to go short on the security. So you can create a short position in the security whenever the RSI rises to overbought when the trend of the security is down. And within a downtrend, whenever the RSI approaches the oversold region, you can use that to trim your existing short positions. Again, as I said, price confirmation is very essential. So I'll keep reiterating that again and again. Now, whenever the trend of a security is sideways, whenever the security is not trending, you can use oversold regions to buy the security, and you can sell it whenever the RSI touches the overbought region, and use that to go short as well if your trading style permits you to do that. But again, as I say, price confirmation is very essential. So the moral of the story is that don't act just on the basis of RSI signal, but wait for some confirmation from price. So let me show that over here. Now, this is the daily time frame chart of Bajaj Finance. In this particular instance, if you see these two, the first two vertical yellow lines, the RSI became overbought. But if you look at the price, after this rally, it just became sideways. It didn't come down. So the price per se did not generate any sort of sell signal. So this overbought signal was not worth acting upon because there was no confirmation from the price. So what happened was that the rally turned sideways for the next several days, and then at some point in future, the RSI ventured into oversold territory. It touched the oversold territory. Now I've put in the zoom in picture of that particular price activity over here. So if you look at the price action, so there was a steep decline in price, a very tall red candle formed, and the subsequent candle was a very small green candle. So following this strong decline, which suggested that the sellers were in control of prices, you have a small green candle that emerged, which tells you that the selling pressure has kind of slowed down. And on the subsequent candle, what happened was that the high of this tall red candle was surpassed. So that was a basic candlestick pattern buy signal. Now, these two candles that you see over here, the tall red candle followed by the small green candle, that is called a bullish harami pattern in Japanese candlestick parlance. Now, that is something that I've talked about in School of Stocks as well as in the candlestick webinar that I did in the last year. So this is a bullish harami pattern. Now, how to act that pattern is that whenever the high of the first candle breaks, that is whenever the high of this tall red candle is broken, you buy. So what we have here is a confirmation. See that the RSI became oversold. So you have a buy warning, and then a couple of candles down the line, you have a buy confirmation from the price. So you could have bought once the high of this red candle was broken, and you would have kept a stop loss below the low of this red candle. Now look at the third and the fourth vertical yellow lines over here. So what is happening was that the RSI is going into overboughts. The RSI is frequently venturing into overbought, but the price of the security is trending sharply higher. So despite the RSI going into overbought, there is no confirmation, there is no sell signal from the price. So you simply don't sell. So that, the rally was very powerful. Then there was a consolidation, then a rally again. Then RSI touched the overbought region and started declining. In this particular instance, if you had taken a buy position over here, you could have cut when the RSI hit overbought over here and started declining, because what happened was that once the RSI became overbought and price started correcting, you had a sort of price confirmation over here. So see that you have a lower high over here and a lower low over here. So this is the territory where you could have closed out your long position that you had created somewhere over here. Then again, later in the chart, if you see the RSI touched the oversold, and from there it started rising. Correspondingly, if you see, I put in a zoom in chart again, there is a small gap over here, and this candle filled that gap. So the gap is being filled. So you have a sort of mini breakout in price. So the overbought signal that the RSI generated, that was soon followed by a mini buy signal in price. So you have a confirmation from the price itself. So this is another instance wherein you could have bought the security and kept a stop loss below this swing low. This candle that you see over here, this candle, you could have kept a stop loss below that low and initiated a long trade. So that is how the price behaved. Here the RSI became overbought, but as you see, there was no confirmation from price. What followed was sideways action and then a rally again. Now the RSI is in deep overbought territory, but again, the trend is very powerful. So you don't just short just because the RSI is overbought. You need to wait for more evidence. So that's how you can, within a trending market, you can use RSI to generate buy and sell signals. Now this chart I've illustrated just for demonstration purpose. Now this is the short term. This is the short term chart over here of Adani Enterprises. It's the 1 hour time frame chart. Now these green vertical lines and these red vertical lines that you're seeing, the green vertical lines stand for good signals, wherein an RSI generated a good signal, and the red vertical line stands for bad signals, wherein the signal that was generated by RSI was false. And these lines are drawn whenever the RSI hit overbought and oversold region. Now, the purpose of drawing this chart is to show that if you look into the number of green lines, there are 4 green lines. And if you look in the number of red lines, there are 4 red lines. So there are 4 green lines and 4 red lines. That is, there are 4 good signals and 4 bad signals. So if you try to act every overbought, oversold signal that the RSI generates, it'll be as good as tossing a coin, because the odds are not in your favor. The odds of you profiting are not in your favor. It's as good as trying to toss a coin. So it is for this reason that not every overbought and oversold signals need to be acted upon. You need to use other tools, and more importantly, you need to wait for confirmation from the price itself. Okay, so that were those were the 4 basic signals that I wanted to talk about RSI. Now let's talk about combining RSI with other tools. One of my favorite tools that I use when using RSI is combining RSI with trend lines. You could also consider combining RSI with other tools like channels, etc. They tend to work very well. But I would suggest that once you start practicing RSI, start drawing trend lines on RSI. They tend to work exceptionally well, especially when combined with price action. Again, as I said previously, don't be obsessed with overbought and oversold zones. Instead, use weight of the evidence approach whenever making decision, and always ensure that you don't act before a confirmation from the price is generated. So this is the 30 minutes time frame chart of Ambuja Cement. So you can see that for the first half of the chart, Ambuja was in a very powerful uptrend. I've drawn a trend line, an uptrend line connecting the lows of the price. I've also drawn an uptrend line in RSI in this particular case. Now, if you see, RSI was rising from this point, it went into overbought territory, and then it broke below this trend line. So you have a trend line breakdown in RSI after the RSI hit the overbought territory. Now that's a warning, but still that's not a sell signal. If you look at the price, when the RSI went into overbought and when it fell below this trend line, when it broke below this trend line, price was still consolidating near the high. So there was no sell signal from the price itself. But later on, if you see, price went on to break that uptrend line. So now what has happened is that there is already a breakdown in RSI when it rose above 70 zone, and a few candles later, there was a breakdown in price itself. So now you have confirmation from price. There is a sell signal from price. So this trend line breakdown in price can be used to go short, keeping a stop loss above the most recent swing high. Then the intermediate downtrend started. So as you can see, price is making a series of lower lows and lower highs. So once we have the second point over here, I drew a trend line and projected it into the future. Now, in this particular instance, if you see that the overbought and the oversold zones worked exceptionally well. So RSI touched overbought, and a few candles later, there was a very swift decline in price. Similarly, at this point, the RSI became oversold, and just a candle or two later, there was a nice reversal in price. Again, based on my personal experience, this is something that I would not have used to go long, because as I said, price is trading below a downward sloping trend line. So price is in a sort of mini downtrend. So I wouldn't have used this particular instance to go long, but rather I would have used this instance to go long. So what is happening is that price is breaking above the trend line that I had drawn. Now that breakout is accompanied by a very bullish candle. So now this particular candle is called a bullish belt hold line in Japanese candlestick parlance. So you have a very tall bullish candle that formed when the breakout occurred. And now that breakout is occurring despite the RSI being above 70. Now, this is one instance where you could consider going long despite the RSI being above 70. The reason is that you have a strong price action. You have price breaking above the trend line, and you have the emergence of a very tall bullish candle. So this is one overbought instance where rather than shorting, you can consider going long because the trend is showing a good strength and there is a breakout in the price itself. So this is one of those rare signals where you can use 70 to buy rather than to sell. Stop loss for this trade, you could keep a few ticks above the low of this tall green trend line that led to price breaking above the trend line. So that is how you can combine RSI with trend lines. In this particular case, I combined the trend line in price with this trend line breakdown in RSI, and it worked very well. You could consider drawing other tools as well. So you could consider drawing, channels on RSI, and whenever you have confirmation from price, you could consider acting. Now here I've combined RSI with Bollinger Bands, which is another popular technical tool that is used to measure the security of, that is used to measure the volatility of the security. So as you can see, I've drawn a downward sloping trend line in both price and in RSI as well. So at this point in time, the RSI became oversold, and a few time later, it went above to break above this trend line. So we have a breakout in RSI. It was more or less accompanied by a trend line breakout in price itself. So breakout in RSI after venturing into oversold is accompanied by a breakout in price. So you have a buy signal. Another interesting thing to note is that price has moved above the moving average of Bollinger Band. So that's also a bullish activity. Now, had you initiated a buy trade over here, where would you have exited the buy position? Well, one good point to note over here is that the RSI is going up, but it's not touching the overbought territory. So you could consider holding on to your long position. Now it touched overbought territory at this point in time, which corresponds to this price region. But still, there is no confirmation at this point in time because the price is still at a high point. It started declining from there. And then what happened was that price is breaking a previous resistance level. So this resistance, price is trying to break over here. Plus price is also trying to break the moving average support of the Bollinger Band. So this is one place where you could have considered exiting your long position that you had built over here. So what happened was RSI became overbought. Then you have a sort of action wherein the price is touching a previous resistance and also trying to break below a moving average. So you could have considered liquidating your existing shorts over here. And what eventually happened was that that breakdown turned out to be false. Price rallied a bit, but then declined sharply. At this point in time, again, when price moved below the lower Bollinger Bands, you will see that the RSI became oversold, and from there it rallied a bit, became sideways. Now, if you see, I've extended this trend line just to show that this previous resistance, which later turned into support, now is acting as a very strong barrier to price. For several candles, price was not able to break above this horizontal white line. And then eventually there was a very explosive candle that emerged, and Bollinger Band started widening. What happened during that time was that the RSI had already broken above this trend line, and the price 3 or 4 candles later broke above this horizontal trend line of itself. So a buy signal was generated again because you have a breakout in RSI, you have a breakout in price, and you have an explosion in volatility as well. So this was another good buy signal that you could have acted upon. Now, how long do you hold on to that buy signal? Well, you hold on to that buy signal until some sort of confirmation from price is generated. So as you can see, the price rallied, declined a bit, rallied, and now is consolidating. Now I've drawn a small horizontal line connecting the low of this candle. Going forward, if that low breaks, then that is something that you could use to trim your existing long positions that you had built over here. So that is how you can combine RSI and confirmation from price. Now, finally, let us talk about changing the RSI settings. Now, as I said, the default reading for RSI is 14. Now, if you reduce the reading of RSI below 14, what will happen is that the RSI will become more sensitive to price change. So the RSI will become very volatile and it will frequently hit the overbought and oversold zones. So more trading signals would be generated. On the other hand, if you increase the RSI setting above 14, that will make RSI less sensitive to price change. So fewer trading signals would be generated. Let me just show you how that looks like on a chart. So this is the chart that is on the top is the default 14 period RSI. So here we are looking at the Nifty Midcap 100 index 30 minutes time frame chart. So this is the 14 period RSI. Now look at the 5 period RSI. If you compare it to the 14 period RSI, it tends to be very volatile. It tends to frequently touch oversold. It tends to frequently touch overbought, and a lot of signals are generated. So the advantage of using an RSI that is less than 14 periods is that more signals would be generated. But the drawback is that because more signals are generated, there is a possibility of greater number of whipsaws as well. On the other hand, if you look at the 30 period RSI and compare it to the 5 period or to the 14 period, you'll see that it is very less sensitive to price changes. Only twice did the RSI touch the overbought and oversold zone for most of the charts. And then at the bang end of the chart, you have RSI touching the overbought zone. So the frequency with which the price will touch overbought and oversold zone tends to be very less. So fewer signals would be generated. But whenever the signals are generated, the chances of being whipsawed would be less. So there is always a trade-off between using an RSI that is less than 14 periods versus an RSI that is more than 14 periods. So let me quickly summarize RSI before I show you live charts and go to the FYERS web platform. So as I said, RSI is a momentum oscillator. It measures, number one, the trend of the security, and number two, the momentum or the velocity of the trend. RSI fluctuates within a fixed band of 0 and 100. Again, that has got to do for the fact that RSI is calculated as 100 minus 100 upon 1 plus RS. So because of the formula that is used in the calculation for RSI, the RSI will always fluctuate between 0 and 100, irrespective of the security you use. It is calculated using average gains and average losses over a specified period. So if the RSI reading is above 50, it means that the average gains are more than average losses over the past n periods. So it tells you that the bulls are in control. And similarly, if the RSI reading is below 50, it tells you that average losses are more than average gains and that sellers are in control. Now, the default reading of RSI is 14, but you can change that depending on your experience and depending on your trading style. If you're a very active trader who is doing a lot of intraday trades, then you can consider reducing the RSI reading below 14. But if you're not so active, if you're doing positional trades, then you could consider increasing it above 14 if you want to. I would advise you to initially keep the default reading as is, but then as you gain more and more experience with RSI and as you understand the RSI formula well, you could then start tweaking the default readings of RSI. RSI is based on the closing price of security, as you know. 70 and 30 are considered extremes, but again, in a trending market, these extreme ranges can change. Now, the beauty of RSI is that not only can it be used in trending market, but it can be used in ranging markets as well. Now, if you attended my previous webinar on MACD, I told you that MACD can only be used in trending market. It doesn't work well in a ranging or a sideways market. But RSI is very versatile. It works very well in sideways market as well, just as well as it works in a trending market. So it's a very versatile indicator. Now, when you combine RSI with other tools like trend lines, channels, etc., then excellent trading signals can be generated. Again, I've highlighted this in red because this is the most important takeaway. Never take a buy or sell decision before a signal is generated from the price itself. Some sort of buy or sell signal from the price has to come out before you decide to trade based on RSI signals. And last but not the least, RSI works on all time frames. So you could use it on 1 minute charts, or you could use it even on charts that are, say, up to 1 month or 1 quarter. So let me now quickly go to FYERS web. Now this is, in order to plot the RSI indicator, what you need to do is, let me just close this. You just need to click on this FX indicators panel that you see over here, just type RSI and select the RSI indicator. In order to change the settings of the RSI, you can just click on this, this gear icon that you see. So that would display the reading. So as I said, the default reading is 14 periods, but you can change it to, say, 45 periods. So the moment I change it to 45, see, it becomes very less sensitive to price. So there's not much point changing it to 45. On the other hand, if I change it to, say, 4 period, then it tends to be very volatile. So it's frequently going above 70, it's frequently going below 30. So it tends to be quite volatile. So the best is to keep it to 14 periods, the default reading. Now again, this is the daily chart of Nifty. If you see, ever since this rally started, the RSI has barely been touching the oversold zone. So that tells you that the uptrend is very strong. It is frequently venturing into overbought. Again, if you look at this overbought, the RSI in this instance frequently ventured into overbought. If you look at the price, it was in a very powerful uptrend. So that is why not all overbought signals should be used to sell, and not all oversold signals should be used to buy. You need to be very aware of, very particular about this. Similarly, if you look at the most recent data, the most recent price action, you will see that the RSI is at a reading of 83.86. Now, just to reiterate, today's reading in RSI in Nifty is the highest since at least 2012. So the current RSI that you are reading is the highest since at least 2012. So that's a 9-year data. So does that mean a sell in Nifty? Well, clearly not, because the momentum of Nifty, the velocity of the uptrend is very strong. So until you don't have any confirmation from the price, you should not be using that to go short on the Nifty. Remember, when the RSI is at 80, it tells you that the buyers are in a very strong control of prices. They are totally dominating the sellers, and the momentum is very strong. So as long as that momentum is intact, as long as no signal is generated from the price, never ever initiate counter trades. So you could use RSI very well even on the hourly time frames, even on the 15-minute time frames, etc. So this is this is the 15-minute time frame of Nifty. See that when Nifty was consolidating, so was RSI, as it was fluctuating within a band of 30 and 70. But as Nifty started to trend, as there was a breakout in price, see that you could have used the RSI, and you could have drawn trend lines to see that early, RSI had sort of generated early signals somewhere over here. If you see, this is the region where price is breaking, and the RSI had broken above the trend line a few candles before. So one thing you need to keep in mind is that RSI is a sort of, it tends to lead price action. So it tends to generate signals prior to price. So you need to closely monitor how RSI is behaving. So that is how you tend to use RSI. Now we'll talk more about RSI in our next webinar, which will be more of an advanced webinar. Prior to that, we'll be publishing the recording of this webinar on our YouTube channel. So if you want to watch this webinar again, feel free to do so. We'll be publishing the video of the recording of this webinar in a day or two. on our YouTube channel. So if you have not subscribed to our YouTube channel, please feel to do so. You could go to YouTube, type FYERS, and subscribe to our channel to stay up to date about the videos that we upload. So in the next webinar, what we'll do is I'll talk more about advanced trading strategies using RSI. So I'll talk about divergences, failures, hidden divergences, RSI ranges, etc. So it'll be more. Today was more about the theoretical side of RSI, as well as to discuss basic trading strategies using RSI, what to do, what not to do, etc. In the next webinar, we'll talk about practical application using some advanced signals. So try to register for next week's webinar if you intend to learn advanced trading strategies using RSI. So next week's webinar will be quite interactive. So that's all that I had to say in today's webinar. In case you have any questions, I'd be happy to take them now. I hope that Surushi might have addressed some of the questions that have come through. And I hope that I was able to explain the basics of RSI in as easy manner as I could. And I hope that you have understood the basics of the RSI. So next week will be more interesting. So try to attend next week's webinar if possible. We'll discuss about more advanced strategies, which you can use not only for intraday trading, but also for swing trading or positional trading. So we'll talk more about advanced strategies next week. So those are relatively rare strategies. So understanding those strategies will help you a lot. So Suruchi, are there any questions that are pending?
Abhishek, I have answered most of it. However, there are 2-3 questions. First is, please explain price confirmation.
Mm-hmm.
Then is, would it be better to use stochastic RSI instead of simple RSI? Yeah. And somebody's asking, Rahul, that please share Excel sheet to my mail. Yeah.
Okay. Answering the last question, what I'll try to do is when we upload the recording of RSI on our YouTube channel, I'll try to upload the Excel sheet as well. I'll see whether that would be possible. If it is, I'll upload the Excel sheet that I showed you in the webinar today, so that you can practice and get a gist of how the RSI is calculated. You get to understand how the mathematics behind RSI is. Okay, now coming back to the first question, which was on price confirmation. So let me again go back to the presentation. 1 minute. Okay, so again, coming back to this chart. So if you see, at this point in time, the RSI went into overbought zone, and then it started declining and broke this trend line. So we have a sort of bearishness creeping in RSI, but when now this horizontal, this vertical red line that you're seeing over here, that represents the precise time when the RSI line broke below this trend line. But then if you look up into price, you will see that this sell signal in RSI is coming when price is still at a high point and still trading above this uptrend line. So as you can see, there is no sell confirmation from price. That confirmation is coming a few candles later when price broke below this uptrend line. So a few candles later, if you look to the right of this vertical line, you'll see that a few candles later, there was a trend line breakdown in price. So that is when the sell signal that was generated by RSI is being confirmed by an action in the price itself. So that is what I am referring to when I talk about price confirmation. So when an RSI has generated, say, a sell signal, you just don't go and sell the stock. In fact, you need to wait for a sell signal from the price before you decide to act. So that's all about price confirmation. You need some sort of buy or sell signal that is generated from the price itself. Either you can use trend lines, or you can use Fibonacci, or my favorite, you can use Japanese candlestick patterns. Now, those are excellent price confirmation tools that you can use. So these are the tools that you could deploy to get confirmation signal from the price. So yeah, that was about it.
Abhishek, there's one more question where Manish is asking that how can RSI be used on hourly chart since the RSI is calculated on daily price closing?
No, that in the Excel sheet, if you go, I've used the daily data where each data represents the closing price of each day. Now, on the 1 hourly chart, if you go into the candlestick chart, so let me just go to candlestick charts. Let me just select 1 hour chart. Let me just reset the chart. So if you see, each candle on the hourly time frame chart is of a duration of 1 hour. So for every hour, you'll have open, high, low, close, open, high, low, close, open, high, low, close, etc. So for every hour, you have a closing price. So that is how RSI is calculated. On the hourly chart, it is calculated on the basis of hourly closing price. On a 1 minute chart, RSI is calculated on the basis of the 1 minute closing price. And on the monthly chart, RSI is calculated on the basis of the monthly closing price. So it depends on the time frame that you are looking at.
Okay, thanks, Abhishek. And I think with this, I will take 2 more questions. After this, I think we will wind up the session. Abhishek, there's one more question from...
Hello, Suruchi, you're there? I guess we lost Suruchi. So what we can do is we can, I've put in my Twitter handle over here. It is @AB In case you have any questions relating to today's webinar, or in case you have any questions relating to technical analysis in general, you can, DM me or send me a message on my Twitter handle, and I would be happy to help. Because I see that there are a lot of questions that are coming in. It'll be difficult to answer so many questions given the time constraints we have.
Actually, there are a lot of questions coming.
Yes.
Yes.
So, yeah. So you could, message me on Twitter, and I would be happy to take your queries. And again, as I said, I'll be holding the second webinar on RSI next week, which will be on advanced trading strategies. So we'll send notifications, the date and the timing for that webinar soon enough. And you can accordingly register. Also, in a day or two, I'll upload, we'll get the recording of today's webinar uploaded on our YouTube channel, along with the Excel sheet that I showed earlier today, if possible. So with that, I guess, Suruchi, we can end today's webinar.
Yeah, so with this, we end the webinar. And once this session recording will be uploaded on the YouTube, there also you can ask questions in the comment segment, and Abhishek can answer to those. So, absolutely. Yeah. So I think thanks everyone for joining the webinar. And thank you, Abhishek. It was really a very insightful and great session. So with this, we end today's session. Thank you, everyone, once again.
Thank you, everyone, and have a great evening, and see you next time.